The final FOMC decision for 2017 is due in just a bit, and the market will be watching closely, as it always does, for such event risk. By all accounts, the Fed is expected to deliver another rate hike, raising rates 25 basis points into the 1.25% to 1.5% range. This means any volatility that ensues in the aftermath will come from other areas, namely forward guidance and the press conference. But before we break it down, there are 3 important points worth highlighting that are exclusively unique to this decision in particular that could make it all a little more interesting. The first is one that may not be getting a lot of attention, but one we believe is important to fully digest. We don't believe the equity market has processed this point, and we continue to highlight risks associated with it. The point is this: assuming the Fed does go ahead and hike rates today, it will be the first time since the global financial markets crisis that the Fed has actually followed through with forward guidance. The Fed has been forced to let down its own expectations with respect to policy outlook over the past several years, consistently moving those goalposts. Most recently, in 2015, the Fed called for 4 rate hikes in 2016 and failed miserably to deliver on that front, producing only 1 hike late in the year. And so when the Fed called for 3 hikes in 2017, the market called its bluff, as it has done so many times before, and yet this time the Fed looks like it will finally follow through. The underlying takeaway is that we are seeing a central bank for the first time erring on the side of policy normalization over policy accommodation. It's true, the path forward will be slow and gradual, but it's a path in which the Fed is now saying it wants to be on, despite reasons to continue to hold off. The perplexing, prolonged period of subdued inflation phenomenon is something that could easily make the case for holding off on another hike, and yet the Fed is prepared to move ahead. So the Fed is now ready to stick to its forward guidance. This should represent a big change for stock market investors who have been pushed the market higher and higher without thought, as their bets of calling the Fed's bluff have paid off time and again. The fact that it won't pay off this time should serve as a warning sign for what could be in the pipeline. It's important to remember that this final Fed hike comes at a time when the market is also getting ready to look past a tax reform policy that allowed the market to continue to drive higher in 2017 despite the onset of policy normalization. So that's point number 1. Point number 2 that is unique to today's decision is the fact that this will be the last presser for Janet Yellen. Yellen will step down in 2018 and Jerome Powell will step in to assume the role of Fed chair. While we wouldn't expect Yellen to deviate from what she would normally say had this not been her last presser, with all that's gone on in the global economy and on the political landscape during her tenure as Fed chair, it will be interesting to see if there are any signs of something a little more out there with respect to her outlook and views. Our final point with respect to those things unique to today's decision is whether or not we get any Fed thoughts on the impact of U.S. government policies on the outlook, with more information now at the Fed's disposal. The Fed has said it would hold off on making any official comments until tax reform was pushed through, and though we aren't quite there yet, the possibility the Fed sheds more light on this matter is a possibility that should at least be considered when following along with the event. So let's break it down quickly now. With the interest rate priced in and considering all that has been said, the bigger on-the-surface focus will be on the Fed's projections and the Fed's outlook with respect to inflation. As far as the projections go, the Fed is calling for another 3 hikes in 2018, but the market is still calling the Fed's bluff, only looking for 2. If there's any change here, the market will react. A drop to 2 hikes on the dot plot will be very US dollar bearish, while a highly unexpected push to a projection of 4 rate hikes in 2018 will be exceptionally dollar supportive. If last week's US hourly earnings and today's softer core CPI are any indication here, the Fed will be sticking to the 3, if not leaning back over to the market's call for 2 hikes in 2018. We believe the Fed will stick with the 3, particularly in light of the Fed's knowledge of all of this in recent months and decision to stay the course. The Fed has expressed concern the subdued inflation may not be transitory as it had thought, though Yellen and company have warned about the risks of just how quickly inflation can shoot up when it does finally move, and this seems to be what will keep the Fed from upgrading its concerns as far as making any changes to the 2018 dot plot goes. U.S. administration policies into 2018 are amongst those things capable of inviting inflation as well. Perhaps we see some changes looking further out, but changes out that far tend not to have as much of a market-moving influence. As far as the currency outlook goes, the short-term picture is more abstract right now, though medium-term the U.S. dollar has been sold at every turn in 2017, and we suspect nothing in today's decision will dissuade dollar bears from continuing to look to sell the buck into any and all rallies, especially with tax reform out of the way and U.S. protectionism likely to ramp up. That's all for now.